The global financial system is not breaking with a loud crash. It is collapsing quietly behind the scenes in a way most people never see. Right now, there is a hidden $5 trillion problem choking world trade, slowing businesses, and freezing capital across borders. This is not a future risk. It is happening today. And almost no one in retail finance is talking about it. While people argue over price charts and short-term moves, the real battle is happening deep inside the plumbing of global trade. And at the center of this battle sits one asset that was once written off, underestimated, and legally attacked: XRP. Welcome back to We Are Cosmic. If you are new here, this channel is where we break down finance, crypto, and macro shifts from an institutional perspective, not hype, not noise, and not emotions. Here, we focus on how money really moves, how power structures shift, and how digital assets fit into the next financial era. If that sounds like the kind of insight you want, make sure you're subscribed, because what we're about to discuss today is much bigger than just XRP price speculation. Let me start with a simple but shocking truth. In 2026, we live in a digital-first world, yet global trade still runs on paper. Physical documents, manual checks, and outdated banking systems are responsible for locking up trillions of dollars every single year. Cargo ships can cross oceans faster than banks can release payments. Warehouses are filled with inventory that cannot be sold, financed, or moved, not because the goods don't exist, but because the paperwork hasn't cleared. This is not efficiency. This is a structural failure. At the heart of this failure is a system most people have never heard of: Nostro and Vostro accounts. These accounts force banks to pre-fund trillions of dollars across the world just to settle international transactions. That money sits idle. It does nothing. It creates a global liquidity desert where businesses struggle to access capital while banks burn money, maintaining a system designed decades ago. The total size of this legacy system is estimated at $27 trillion, and it is collapsing under its own weight. This is where XRP enters the conversation, not as a speculative meme, not as a fast payment coin, but as a liquidity bridge designed to replace this exact problem. XRP is no longer fighting for relevance. It is stepping into a role the global financial system desperately needs filled. The transition we are witnessing right now is XRP moving away from retail-driven volatility and toward institutional-grade settlement infrastructure. What makes this moment different is timing. For the first time, the technology, regulation, and institutional demand are aligning. XRP was once seen as a legal liability. Today, it is increasingly viewed as a solution. Wallet growth is rising. Exchange balances are falling. Supply is quietly moving away from speculative trading and into long-term custody. This is not what hype looks like. This is what structural change looks like. If the $5 trillion trade finance wall stays in place, global growth stays limited, businesses stay underfunded, capital stays frozen. But if that wall comes down, everything changes. And the question we need to ask is not, can XRP do this? The real question is, what happens if it does? To understand why this opportunity even exists, we need to be honest about one uncomfortable fact. The global trade system is not slow by accident. It is slow by design. It was built for a world where paper was trusted more than code, where banks controlled information flow, and where delays were profitable. That design no longer works in a world that moves in real time. And yet, it is still the system holding global commerce hostage. Today's trade finance runs on physical documents like bills of lading, invoices, insurance certificates, and letters of credit. These papers are passed from desk to desk, country to country, and bank to bank. Every handoff creates delay. Every delay creates risk. And every risk forces banks to add more checks, more buffers, and more capital requirements. This is how a shipment worth millions can sit idle in a port while businesses wait weeks just to get paid. This is what people mean when they talk about the $5 trillion trade finance gap. It is not missing money. The money exists. The goods exist. The demand exists. What is missing is liquidity at the right moment. Capital is trapped inside processes that cannot move at the speed of global trade. As a result, small and medium businesses suffer the most. They cannot access financing, they cannot scale, and they cannot compete with firms that have deep banking relationships. At the core of this problem are Nostro and Vostro accounts. Banks are forced to keep large pools of money parked in foreign accounts just so they can settle transactions later. This is like keeping cash locked in thousands of drawers around the world just in case someone needs it. It is incredibly inefficient. Trillions of dollars sit idle, earning nothing, while businesses struggle to survive. This is not liquidity. This is wasted potential. Because there is no single shared digital truth, banks do not trust each other's records. So they duplicate checks, they reconcile balances manually, they build layers on top of layers to protect themselves from errors. These systems can take days or even weeks to finalize a transaction, and every delay increases costs across the entire supply chain. Consumers pay more, businesses lose margins, economies slow down. Now, here is where things get interesting. The banking world knows this system is breaking. The cost of maintaining legacy infrastructure is rising every year. Compliance costs are exploding. Settlement risks are growing. And as global trade volumes increase, the cracks are becoming impossible to ignore. Banks are reaching a point where staying the same is more expensive than changing. This is why the idea of a neutral bridge asset is so powerful. Instead of pre-funding accounts all over the world, banks can use on-demand liquidity. Instead of waiting days, settlement can happen in seconds. Instead of trusting paper, institutions can rely on cryptographic proof. This is the exact role XRP was designed to play. The XRP ledger does not try to replace banks. It replaces friction. It removes the need for trapped capital. It allows value to move when it is needed, not days later. And because it operates as a shared neutral layer, no single institution controls it. That neutrality matters more than most people realize. This is also why the conversation has shifted from payments to trade finance and inventory tokenization. When physical goods can be represented digitally on a ledger, they become usable as collateral instantly. A shipment sitting in a warehouse is no longer dead weight. It becomes liquid. It can unlock financing the moment it is verified. That is how you break a liquidity desert. The legacy system is like a paper fortress. It looks strong, but it is fragile. One missing document, one error, one delay, and the entire process stops. The XRP ledger offers something radically different: real-time verification, real-time settlement, and real-time liquidity. Not as a future promise, but as an operating system that already exists. What truly confirms that this shift is real is not marketing, not announcements, and not social media narratives. It is on-chain behavior. Markets can lie. Data usually doesn't. And when you look at what is actually happening on the XRP ledger, you begin to see a clear transition taking place, one that separates speculative noise from structural adoption. For most of its life, XRP was treated like a high volatility trading instrument. It lived on exchanges, moved with sentiment, and reacted to legal headlines. That phase is slowly ending. In its place, we are seeing something far more important: migration into custody and long-term holding. Unique wallet addresses on the XRP ledger have surged, crossing millions, while exchange balances have dropped sharply. This is not how speculative assets behave at the start of a hype cycle. This is how infrastructure assets behave when institutions begin positioning early. A drop of more than 50% in exchange-held supply over a single year is not accidental. Institutions do not keep assets on retail exchanges. They move them into cold storage, custodial solutions, and regulated vehicles. This tells us that XRP is increasingly being treated less like a trade and more like strategic liquidity. When supply quietly leaves exchanges, it reduces sell-side pressure and increases the importance of demand spikes when real utility activates. This change is happening at the same time the XRP ledger is expanding beyond simple value transfer. The focus has shifted to tokenizing real-world assets, especially physical inventory tied to global trade. This is the missing link. If goods can be digitally represented on a ledger, they can be financed instantly. They can be insured, verified, and transferred without relying on paper documents that slow everything down. The old system forces businesses to wait until after verification to get paid. The new system flips that model. With tokenized inventory, verification happens digitally and instantly. Payment can trigger the moment a condition is met. This is not a theoretical improvement. It directly attacks the core inefficiency of trade finance. The XRP ledger is positioned well for this because of how it handles complexity. Instead of pushing risk into external smart contracts, it builds functionality directly into the protocol. That matters for institutions. Banks are not looking for flexibility at any cost. They are looking for predictability, security, and compliance. When features live at the protocol level, the attack surface is smaller and the rules are enforced by the network itself. This is where new standards like the multi-purpose token, or MPT, change the conversation. A single token can represent ownership, legal rights, insurance status, and settlement conditions at the same time. Instead of dozens of documents, there is one programmable digital object. This reduces cost, time, and risk across the entire trade lifecycle. Even more important is privacy. Institutions cannot operate on systems that expose sensitive data. The XRP ledger addresses this by allowing confidential verification. A bank can confirm that a shipment exists, that it is insured, and that conditions are met without seeing private commercial details. This solves a problem that has kept large financial players on the sidelines for years. Once assets become programmable, liquidity becomes automatic. Payments no longer depend on trust or manual checks. They depend on math. When a digital signature is recorded at a port, funds can move instantly. That is not decentralization for ideology's sake. That is efficiency for survival. This is why the XRP ledger is evolving into a sandbox for institutional finance. It is not trying to replace every blockchain use case. It is focusing on where it matters most: regulated, high value, real world flows. And this is exactly where the largest pools of capital live. But here is where we need to slow down and stay honest. Technology alone does not guarantee victory. Many superior blockchain systems have failed because they underestimated politics, regulation, and sovereign power. If technology alone decided winners, this conversation would already be over, but global finance is not ruled by code. It is ruled by power, sovereignty, and regulation. And this is where the real battle for XRP is being fought. The biggest risk to the XRP ledger is not a faster blockchain or a better token standard. It is the possibility that governments and central banks choose to build their own closed systems and shut the public out. Central banks do not like losing control. They do not like neutral networks. They do not fully govern. This is why we are seeing the rise of CBDC-focused projects like mBridge and other unified ledger initiatives backed by institutions such as the BIS. These systems promise instant settlement between nations without touching public blockchains at all. On paper, that sounds like a direct threat to XRP. If governments settle directly with each other using private rails, where does a public ledger fit in? That is the question skeptics ask, and it is a fair one. History is full of technically brilliant systems that failed because they were politically inconvenient. There is also the issue of utility versus financialization. Critics argue that XRP's price action is still driven more by ETF inflows and institutional accumulation than by millions of daily trade finance transactions. In other words, XRP could become a financial product before it becomes a financial utility. If that happens, price may rise, but network usage could lag behind expectations. And then there is execution risk. The XRP ledger roadmap for 2026 is ambitious. Privacy features, native lending, tokenization standards, and institutional tooling all need to work seamlessly. If developers do not build on these features, they become unused infrastructure. A blockchain without developers is like a highway with no cars. This is why caution matters. Utility-based assets can be just as volatile as speculative ones, especially during transition periods. If XRP fails to convert institutional interest into sustained transaction volume, it risks becoming a beautifully engineered system that never reaches escape velocity. Now, here is the part many skeptics underestimate. Banks do not just want control, they want profit. Building private siloed CBDC systems is expensive. Maintaining them is even more expensive. Every closed network recreates the same inefficiencies that already exist, just in digital form. Over time, cost pressure changes behavior. This is where XRP's neutrality becomes a strength rather than a weakness. A shared liquidity layer allows institutions to interact without each building and maintaining their own infrastructure. It reduces duplication. It reduces friction. And most importantly, it reduces cost. When margins tighten, ideology fades fast, and this brings us to regulation, XRP's strongest advantage. While many crypto projects treated compliance as an afterthought, Ripple made it the foundation. Years of legal battles were not just survival, they were positioning. By 2026, compliance first is no longer a slogan, it is a moat. Ripple has secured regulatory approvals across dozens of jurisdictions. One of the most important is in Europe, where a single electronic money institution license allows passporting across all EU member states. This means Ripple can legally offer blockchain-based financial services across the entire Eurozone without fighting country by country. The UK followed a similar path. This matters because large banks do not experiment with systems they are not legally allowed to use. Regulation is not optional for them, it is the entry ticket. With over 75 regulatory approvals globally, Ripple has quietly become one of the few digital asset infrastructure providers that conservative institutions can actually touch. This regulatory clarity positions the XRP ledger not as a rebel system, but as financial plumbing. And plumbing does not need to be exciting. It needs to be reliable, legal, and cheap. While most people are still focused on charts and short-term price swings, the real shift in XRP is happening in the background, inside market structure itself. This is where things start getting uncomfortable for retail traders, because Wall Street is no longer watching. It is acting. Over the past year, XRP has experienced what can only be described as a historic exchange drain. The amount of XRP sitting on centralized exchanges has fallen by more than 50%. Dropping to levels not seen in 7 years. This matters far more than daily candles. Exchanges are where liquid supply lives. When supply leaves exchanges, it is no longer available for quick selling. It becomes harder to access, harder to move, and much harder to shake loose. This is not random behavior. Institutions do not speculate the way retail does. When regulated funds buy XRP through ETFs or custody products, that XRP is effectively removed from circulation. It goes into cold storage, governed by compliance rules and long-term mandates. This is why ETF inflows matter even when price appears slow. They change the structure of the market, not just sentiment. Since the launch of spot XRP ETFs, we have seen billions of dollars flow into regulated vehicles managed by firms like Franklin Templeton, Bitwise, and 21 Shares. These entities are not momentum traders. They are allocation managers. When they buy, they are positioning for multi-year outcomes. Every unit of XRP they absorb tightens available liquidity for everyone else. This creates what is known as structural accumulation. In this environment, dips are not invitations for panic. They are opportunities for large buyers to absorb more supply. This is why pullbacks are increasingly shallow and why sell pressure feels weaker than it did in previous cycles. The market is changing hands. As exchange balances shrink, volatility does not disappear, it changes character. Instead of long grinding downtrends, you get compression. Pressure builds quietly, liquidity thins out, and when demand finally arrives from real utility, the price response can be sharp and disorderly. This is how infrastructure assets move once adoption crosses a threshold. This is also why risk management becomes critical. In a market where supply is fragmenting across custodians, ETFs, and cold wallets, single points of failure matter. Exchange outages, regulatory freezes, or access restrictions can catch unprepared investors off guard. Redundancy is no longer a luxury, it is survival. At the same time, we need to be clear-eyed. Institutional accumulation alone does not guarantee success. If XRP remains a financial product without matching transaction growth, the narrative breaks. Sustainable value comes from usage, not just ownership, and this is where the trade finance thesis becomes essential. When real-world assets begin moving through the ledger, inventory, commodities, private credit, tokenized treasuries, demand for XRP shifts from optional to required. XRP becomes fuel, not just a store of value. That is the difference between speculation and infrastructure. This is why the timing matters. A shrinking liquid supply meeting a rising utility curve is a dangerous combination for anyone betting on stagnation. The fewer tokens available, the more sensitive the market becomes to incremental demand. This is how price floors form, not through hype, but through structural necessity. Institutional research desks understand this dynamic well. They track liquidity, not just price. They model supply shocks, not social media sentiment. And when they see exchange balances collapsing at the same time regulatory clarity and real-world use cases are expanding, they pay attention. What ultimately separates short-lived crypto narratives from lasting financial infrastructure is real-world integration. And this is where the XRP ledger story in 2026 reaches its most important phase. We are no longer talking about a single use case or a single market. We are talking about the tokenization of the global economy itself. The vision has expanded far beyond cross-border payments. The XRP ledger is being positioned as a factory for real-world assets. Gold stored in vaults, oil moving across oceans, private credit agreements, government bonds, and corporate treasuries. When these assets are transformed into digital tokens on a shared ledger, they gain something they never had before: instant liquidity and global accessibility. Tokenization removes the silos that have defined traditional finance for decades. Instead of assets being locked inside regional systems, they can move freely across borders in real time. Settlement no longer takes days. Collateral no longer sits idle. Capital flows where it is needed, when it is needed. This is not just efficiency, this is a structural upgrade to how value moves. Key partnerships are accelerating this shift. Integration with enterprise banking platforms allows hundreds of millions of bank accounts to interact with digital assets without users even realizing they are touching blockchain infrastructure. At the same time, tokenized U.S. treasuries and regulated stablecoins are proving that the XRP ledger can handle the most sensitive and regulated instruments in global finance. Institutions do not experiment with assets like these unless they trust the underlying system. A major reason for that trust is how the XRP ledger approaches risk. Instead of relying on complex external smart contracts, it is building critical financial functions directly into the protocol. Native lending, collateral management, and settlement rules are enforced at the network level. For institutions, this dramatically reduces the chance of exploits, bugs, and catastrophic failures. Security is not an add-on, it is baked in. As more real-world assets move on-chain, demand for XRP scales naturally. XRP is not competing with these assets. It is enabling them. It acts as the liquidity bridge that allows value to move between tokenized systems instantly. This creates a feedback loop. More assets bring more volume increases liquidity demand, and higher demand tightens supply further. This is where the $5 trillion trade finance problem comes back into focus. When trade inventory, commodities, and financial instruments begin settling through the ledger, XRP is no longer optional infrastructure. It becomes a requirement, and when a hard-capped asset with declining liquid supply becomes required infrastructure, price dynamics change fundamentally. This is why institutional researchers are no longer dismissing XRP as a speculative outlier. They are modeling it as infrastructure with a supply constraint. Price targets are not pulled from thin air. They are derived from liquidity needs, transaction velocity, and supply availability. When multiple forces converge, ETF accumulation, exchange supply decline, regulatory clarity, and real-world utility, a new price floor begins to form. The narrative of 2026 is not about legal battles or retail hype cycles. It is about institutional re-entry. It is about the return of serious capital. And it is about a market finally aligning with the mechanics of the XRP ledger. When that alignment happens, price discovery becomes less emotional and more mathematical. None of this removes risk. Execution still matters, adoption still matters, developers still matter. But the difference now is that the infrastructure is built, the regulatory doors are open, and the incentives are aligned. The question is no longer whether XRP has a use case. The question is how fast that use case scales. We are witnessing the closing chapter of the speculative era and the opening chapter of the utility era. The $5 trillion showdown between legacy banking and modern liquidity is no longer theoretical. It is live, it is measurable, and it is unfolding on the ledger in real time. If you want to keep tracking this shift, stay connected with the community, and understand how institutional money moves before it shows up on the chart, make sure you're subscribed here on We Are Cosmic. The next global financial era is not coming. It is already built. I'll see you in the next one.